plus population, okay, who wants consumption, who have a rising standard of living, rising standard of expectation. So that's the reason you'll be bullish in India, because all drawdowns are very sharp, but swift also.
Swift, yeah.
They just take out. Before you know it, it'll be back on there. So you're lucky. You're living in a place that if you're bullish, you're generally going to be right 80% of the time.
Right.
So, but bear markets do happen. Let me tell you, they're very painful. I've been through a lot of them in India and overseas. They're very, very painful. The best example I can quote to you is the Dow Jones hit, I think 1,000, the number 1,000 for the first time in 68. It didn't cross it until 1982. A period of 14 years, the Dow did cross 1,000 on the index. Then when it crossed it, finally went to 10,000. But leave that aside.
Yeah.
So I'm saying that, bear markets can be prolonged. Okay, but then the beauty of this is as follows, that you can make a lot of money in a bear market also. People will think, first of all, you build your portfolio for the bull market. Secondly, within the bear market, you find great companies. Like, for example, Infosys came out in the middle of the 92 bear market. So you bought that, you made good money. But also trading opportunities. If you're skillful at that, you can trade from the lows to the highs once you figure out it's a trending market, or trading market. So, money can be made in markets because it's volatile. Money can be made at almost any types of markets. The big money is always made when you buy at the bottom of a bear market. It's like the tiger crouching and waiting for his prey. At the weakest point goes and attacks them. So the weakest part of the market is in the middle of a bear market, and all the values are in your favor. No one is interested, so you can buy the quantities you want at the price you want. That is the sweet spot for investors.
So we built about 15-60 lakhs of reserve, but for membership you need 25 lakhs. So we borrowed 10-12 lakhs and bought the card, and we became zero again. And that time this Raamdeo Agarwal was building. From that 12-15 lakhs, in next 18 to 24 months, we had 30 crores in it. That was the happening of Mudra. In fact, that Raamdeo Agarwal happened only for us. Kind of, like Y2K happened for India. Same way Bull Run happened for us. So we had 30 crores. And then when it collapsed, we actually ended up buying a lot of bank shares at that. Banks were so cheap, you cannot believe.
Before the
Raamdeo Agarwal, like entire Vaishya Bank was around 5 crores. 20 rupees per share and 2.5 crores equity. $10 share. 5 crore पूरा वैश्य बैंक मिलता है। आपको ICICI बैंक मिलता था कुछ 200-400 करोड़ में। So ऐसे हमने सब बैंक के शेयर खरीदे, हमको बहुत क्लियर था। And scam कहाँ हुआ? Banks में हुआ। So हमारे 30 करोड़ 10 करोड़ हो गए, मिट्टी हो गया।
One question here. So when did you have that 12 lakh, right? How did you make it to 30 or 10? So basically, see, because it's like you bought something that went up, or it was like part trading, part.
No trading.
So then what like?
See, एक तो पहली बात जो you don't know what happened in 92. 92 was like a rocket.
Crazy, yeah. It was crazy.
This is nothing. जो बाजार कुछ नहीं.
Correct.
It's like a market went 6 times. From 1,000 to 4,200 in less than 2 years. It's almost like a 4x index itself. अब ये समझिए कि मतलब 30,000 वाला जो 1,20,000 है, ऐसा इंडेक्स हो गया 2 साल के अंदर, ओके। और उसमें क्या हुआ कि जो जितने जंग से कोई भी स्टॉक में कोई भी थीम लगाओ, मतलब 10 वाले से 100 रुपए तक होती थी, कोई भी वहां भी गया। So there was lot of trading churn of the clients. So they used to give us lot of brokerage. See, what happened was we were one guy. So the moment you become broker, 6 sub brokers can work for you. So I deployed 6 guys to go to the ring. So my capacity went 6 times. So, and the brokerage that time was 1.5%. So I started making entire 1.5%.
Right.
So the brokerage was massive, and we were investing. The moment brokerage is booked today evening, I'll buy tomorrow morning stock against that.
But when you are in the market and you see on a day-to-day basis that things are going crazy, how was it difficult for you to sort of, when things around you are going crazy to that extent?
No, because I used to always feel that there should be some enough money with me to sustain my lifestyle.
Okay.
And that was always there.
Right.
Even if the market crashed also. So, that was not the problem. The wealth coming, because in my opinion, I always tell my children also, even now, whatever is our investment in stock market, you should take 25% of that as our investment. Suppose it is 100 rupees today, our 25 is ours, that's all. 75 is not ours. Suppose it goes down to 80, then only 20 is ours. So we have to try to learn and live within that 20 or 25. not think about the balance.
So 3/4 of it you are willing to look at as a drawdown at any point.
At any point of time, it can go down
It
to
can
that
go
level.
down.
Because it happened, once in 2008 crash, the stocks that we held fell the maximum because they were illiquid and there were no takers at all. So Sundaram Fasteners used to be $50, it came down to $13. Sundaram Clayton came down to $100 from $200. Like that, all these stocks that we were holding, Myco came down, Vapco came down, everything came down. Vapco is not there, of course. Everything came down. 2008 crash. So my 100 rupees became 20 rupees that time. But that 100 rupees was big enough to sustain again.
But when you are in the market and you see on a day-to-day basis that things are going crazy, how was it difficult for you to sort of, when things around you are going crazy to that extent and sort of...
No, because I used to always feel that, there should be some enough.
You can afford to not look at charts. And both are typically the same. One is a person who's got such a long-term view of the business. He's going to look at the business from a 10, 15, 20 year point of view. So if I was the promoter of a company and I'm driving the value of this company and I know this is what I expect to achieve in 5 or 10 years, I'm not really looked at what market, because I know the market will be afraid of this and doing this and all that. So if I'm an investor of that type, then I'm as good as the promoter of the company, then I'm going to be interested in what is this company going to do in 10 years or 15 years. Then I'm going to look at price, because price gives me no information. Second is, we got inexhaustible sources of funds. Every year my portfolio sizes is 1,000 crores, and every year I'm going to get another 300 crores for some source. Perfect. It's a classic example. He keeps getting more and more money. He doesn't have to look at a chart because he always has money to invest. But if you're operating in a closed box, I got an X amount of money. I'm not getting more money except from profits I book. That is my availability of funds. Now, if I buy a stock at 500 rupees, it goes up to 600 rupees, and it drops to 300 rupees. Now I think 300 rupees is very cheap. Where am I going to get more money to invest in? But suppose when it went up to 500 rupees and went up to 600 rupees and it dropped at 500 rupees, and I said, ठीक है, कुछ problem है, बेच देता हूँ. It goes to 300 rupees. I have money to buy at 300 rupees. In fact, I can build up a position to 1.5 times what it was before. So if you have limited supply of money, and I'm not talking about the size of money, it's you can have 10 lakhs unlimited, or you can have 100 crores unlimited, or you can have 10,000 crores unlimited. Limited is limited. Right. Once you have limited source, your money comes from your stocks only. So you can't afford to let stocks go down, and then you become passive investor. 300 में मैं तो बेच नहीं सकता हूँ, बहुत सस्ता है, ले नहीं सकता हूँ, मेरे पास पैसा नहीं. So I become observer in this thing. Right. Or I say I give up now, and this also very often happens. So I think it is very, very important to. Otherwise, you become bystander.
See, one sort of view among investors is when you have these all corporate governance issues, the management is such, it's better to avoid rather than get into it and then to sort of either save your investment or make money.
Wherever you invest, that happens or no, how do you know?
I mean, you consciously try to see if it happens after every effort that you've made, after every way that you think you want to avoid it, then you take a call what you want to do, right? Some people could say, okay, fine, take the loss and get out rather than wasting energy, focus on other areas. It's just a thought, right?
Correct, but by that logic, you'll be left with only 20% of the district company.
Correct.
See, and 20% also, you don't know, like Infosys, Mr. Narayan Murthy is questioning the corporate governance, where would you go? So, I mean, I differ with you. You can't limit yourself. I mean, you have to. Then you have to ask for the right, because you don't know wherever you think you are right, it may not be come true like that. Like S. Kumar, you are telling Hari Bhakti is the auditor. How on the earth can you feel that the Hari Bhakti has signed these accounts?
But I've realized one thing. To some extent, investing in turnarounds is no different than investing in event-based. Again, when we've analyzed our own track record, we found that there are several of these misses, or more than misses, these CAGR killers have come from turnaround. Because the turnaround is contingent on A, B, C happening. And the mind, the way it functions, it tries to simplify problem solving. You cannot simplify it beyond a point in time, because how do you know that all of these will fall into place? And in the time frame that you desire that they will fall into. And therefore, today, but turnarounds, if you get them right, also make you a lot of money, and that's the lure. वो lure बहुत strong है, क्योंकि वो turn around नहीं हुआ है इसलिए आपको सस्ता मिला. और when you, और क्या होता है कि when you are buying a turnaround, you obviously also construct a scenario of कि ये हो जाएगा तो क्या numbers होंगे, और अगर ये numbers हो गए तो क्या valuation मिल सकता है. And that is not a bad way, because if you can assess the risk reward. See, I think finally all investments you made, it's all about risk reward. So the risk reward is great, but the strike rate is not. The probabilities are low. And I've realized that even in our portfolios, to not over time, I've realized that especially when market valuations are elevated, there is a tendency of the people to gravitate towards turnarounds. Because they are cheap, because your mind will not allow you to buy something at a 30-40p, because that's the way you've been kind of brought up. Or if you consider valuation to be an important parameter. So you try to look for a cheaper alternative, which usually has something which is not fitting, right? And the mind tends to force fit it and say, "Nahi, ye to ho jayega." And then it takes, either it never happens, or it takes the ever for happen, or before that happens something else goes wrong.
Or you sell it just before it happens.
Or you sell it, you finally give it up and you sell it before it happens. Right? So we are having a field time in the office because Bombay dyeing is going up 5% every day, and we held it for a long period of time. Not that our hypothesis was wrong, deep value, not even anywhere else. I said real estate mein to you be where you can see, look, feel. So Bombay mein, in the heart of the city, right? And still we didn't make money. And now people come and tell us कि Bombay dyeing अच्छा लगता है.